Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in and take a look, see what's going on today. If you want to follow me, it's at Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics, subjects, looking for investment opportunities, sharing those opportunities with everybody in the community. We do have a coupon code that is active. Special is the coupon code. You can get 50% off the first month only. It ends up being $25 for that first month. Or you can save $100 on a yearly membership, which ends up being $500 for the year. And you can always swap from the monthly to the yearly if you'd like to do that using that code. So Global Investor says, almost never in history of the U.S. economy has consumer sentiment been this depressed. The U.S. consumer sentiment current conditions assessment fell to an all-time low. This is likely the worst perception of the U.S. economy since the 1930s Great Depression. And this is Michigan Consumer Sentiment Index current conditions. We have the 1980s double dip recession, great financial crisis, and we are below everything that is on this chart. I would argue, generally speaking, it's a good time to be bullish when everyone else is bearish. And does this mean that we're at the bottom? I don't know. Uh, Usually, when you get these bottoms, it's been a pretty good time to be buying certain asset classes. But irrespective of what the consumer sentiment is, it's always good to buy undervaluation. So, I mean, that's what I'll say there. It's always good to buy undervaluation, irrespective of what some of these charts really look like. So, coming down, we've got overall, this is Christian. Overall, metals dominate the bullish narrative due to scarcity and green transitions. WTI is the sleeping giant of commodities. When crude breaks out, it will drag the whole complex parabolic. In his opinion, I would agree. It seems like oil's kind of lagging behind, but when oil goes, it's going to grab it. Now, why is that the case? Why is that my opinion? Because I think interest rates are going to go up with oil, and interest rates are going to cause more money to flow into commodities and away from financial assets if that does occur. So if oil goes up, I do think that interest rates will follow it, and then that will cause more money to rotate out of financial assets and into hard assets. And that was in response to Warren Pye. He says the commodity complex is starting to get interesting. Multi-year bases and, depending on index construction, some breakouts. There we go. Market Sniper. He says the inflation chart below illustrates how far gold has still to go till its 1980 moment. The last time consumer price index had a similar rise to now, right arrow, was 1965 to 1973, which is the left arrow. The red part followed. So he's saying that right now we're in the general area of 1973. So let's go back and see from a ratio perspective what that looks like. So let's do like gold divided by the M2 money supply, because we should be at a similar situation to that. So 1973 was, well, we're going to have to go before this. So we got another one. Hold on. We can do XAU USD over that. So according to the ratio, 1973 was like here. From that particular level in relationship to the M2 money supply, that would be analogous to 2006 and 2022 when we bottomed. But I would say that's kind of roughly the areas that would be equivalent from gold to M2 money supply. So I would say it's not necessarily equivalent. We're also, if you look at this, breaking out of resistance perhaps right through that resistance area. We might have another big run like parabolic style coming in the near future here for gold outperforming the M2 money supply. So, yeah, that's what I see there. I just try to see like where it's located. Let's do XAU USD divided by the S&P 500. We'll do a white line. 1973 is right where we're located, actually. So you could argue from this perspective, your bottom here, and then the break. This is your bottom here, and then the break is about to come. So from a gold to S&P 500 or hard asset to financial asset, we're about to break here of this ratio. And that's what I do when people make claims like this, like CPI. I go and I look at the ratios to see if we're kind of located in the same location, which this one is. Surprisingly, it is right there. And if we can break out of all that, this could be a big move, a very big move. So that looks interesting. Energy Bros used to always bash Citibank and particularly Ed Morse, but now Citibank is super bullish on XLE, which they call hated. 6% off all-time high, so Citibank is in the energy bruh camp and saying that oil is going to be the new gold next year. I'm staying on the sidelines. Good luck. Inflation running wild again. They say soon all commodity charts will look like gold. B of A's Hartnett goes bullish on commodities. So Bank of America Chief Investment Strategist Michael Hartnett thinks that oil and energy stocks are the best contrarian bet for 2026 after a long period of underperformance. Hartnett says that Trump's administration is going to run it hot. Economic policy will see commodities boom and outpace bonds next year. He regards the despised oil energy sector as the best contrarian trade out there after a long period of underperformance with the State Street Energy Select sector XLE having tumbled this year. I don't think XLE tumbled this year, but okay. But yeah, that's an opinion. That's one opinion. Here's another one from Tavi. He says energy stocks keep inching higher, quietly building the pressure for what I think could become a sharp, decisive breakout. You can't perfectly time these inflection points, but the macro pieces are falling into place. Positioning remains deeply bearish. U.S. oil and gas rigs are contracting meaningfully. Oil is trading near one of the cheapest levels in history relative to the money supply. Energy weight in the S&P 500 is hovering near record lows. It reminds me of when people said I was crazy for buying mining stocks, insisting metals would never move. While my conviction in miners hasn't changed one bit, I also see energy equities as one of the most fundamentally attractive corners of the market right now. And again, he's showing the gold miner breakout, copper miners breakout, and we're going to see energy stocks follow. We've got a big question mark there. I think we're going to do the same thing. So we're just waiting for that big breakout in energy stocks. So here's Qatar. Qatar warns the world is sleepwalking into a 2030s supply crisis. A global LNG shortage is already forming. Qatar's energy minister just sent the strongest warning the LNG market has heard in years. Despite record LNG construction today, he says the world is heading toward a structural gas shortage next decade, driven by AI power demand and chronic upstream underinvestment. The numbers are alarming. AI data centers could add 3 to 6 billion cubic feet per day of gas demand by 2030 from almost zero today. Qatar's lifting LNG output from 77 MTPA to 142 MTPA by 2030, basically doubling. It will mark it almost 160 MTPA, including US projects nearly 20% of global LNG. The world will add 360 billion cubic meters per year of new liquefaction by early 2030s. But underinvestment means this still may not be enough. US Qatar will supply 80% of all new LNG coming to market this decade. And a huge portion of Qatar's new capacity is uncontracted, meaning Doha can time and price the market with precision. Why is Qatar is worried? Al Kahabi's message is blunt. The world thinks it is oversupplied today, but the AI-driven power loads exploding, Europe phasing out Russian gas, Asian demand rising, and upstream investment lagging. This market could flip into a sharp LNG deficit by the early mid-2030s. This is the same setup we saw before 21-22 gas crisis, only bigger. So the US factor, the United States is Qatar's only real peer. We've got Golden Pass, Plaquemines, CP2, Port Arthur, and Rio Grande. These projects push US LNG towards similar scale as Qatar by 2030. But even US exporters are warning. AI power loads could tighten domestic gas balances and push Henry Hub higher, raising contract risk. This is why American suppliers are rewriting LNG contracts with more hybrid or non-Henry indexation. Portfolio players are about to face real competition. Trading plans to scale to 30 to 40 million tons of traded LNG by 2030, half from non-Qatari volumes. That puts it squarely against Shell, Total Energies, and BP, and it will compete with unmatched cost advantage. The two market scenarios. Scenario one, Qatar's warning comes true. AI demand and weak upstream investment equals a tight LNG by 2030s. Prices firm, long-term contracts surge. Then a snap tightening. Late LNG wave, scenario AI demand plus upstream investment equals tight LNG 2030s. Prices firm, long contract surge, low cost suppliers win. Scenario two, we have a temporary oversupply, then a snap tightening. Late LNG wave, we have a brief glut, rapid tightening mid-2030s. Qatar manages its uncontracted volumes to avoid a price crash. Either way, the age of cheap LNG is ending. There we go. We've got Warren, and we already talked about that one briefly. Lucas says gold has replaced bonds as a hedge against equities. The negative correlation between bonds and equities has broken. They now move together. It's exactly what I was thinking would happen. If you're looking at hedge both equity and geopolitical risk, gold is becoming increasingly attractive, and that's because of the market conditions. When you're in an increasing interest rate environment, gold outperforms. When you're in a declining interest rate environment, you generally see financial assets do decently well when they get below 5%. Here's a quote from Charlie Munger. He says, "I'm sick and tired of this warship of high-priced growth stocks. Paying 40 times earnings for a company growing 15% a year is not investing. It's a greater fool game dressed up in spreadsheets. We have never in 75 years bought a single share for anything at a price that did not give us an enormous margin of safety. Not once. And we never will. We'll keep buying dollar bills at 30 to 40 cents when the world occasionally goes crazy and hands them to us. That is the entire game." That's the entire game. That's what we need to incorporate in our investments to protect the downside. And that's what exactly I've put into a lot of my investments is I buy things when they're cheap and I'm paying 30, 40 cents or lower per dollar of value that the company has. So that's what I've been trying to do with a lot of the picks on the website. Here is URA. So we now have expected ratio chart breakout plus a back test in the making. It means that the uranium ETF URA is in a huge breakout mode versus the SPX, S&P 500, from a very symmetrical blue 9-year inverse head and shoulders pattern. The glorious commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. As said now, since called the commodities lows 5.5 years ago, do not miss it. Uranium miners did a 580% bull move in its baby bull move. Still just getting started. The next phase is now starting. Caught all major lows on that. We have a company that's about a 10 bagger at the moment already. And we're just breaking out, guys. This is beginning. Could this be a big time winner? Well, it already is. And I think we're going to extend it even further for those that are patient enough to ride this thing for the entirety of the bull market. So fingers crossed for those that are in that. I'm riding it with you, and I'm being patient and trying to ride this thing for its entirety. I've got a lot of money riding on uranium and a lot of other sectors too. And I think that I am appropriately allocated to the sector, and I hope we really get to rip here. I really hope. And this could last for a long time, guys. It could last for a decade plus, 2 decades, 3 decades. I mean, it could go. When I look out in the future, all of the solutions to energy problems are electricity based. And if we're going to ramp electricity, I don't see how nuclear and uranium doesn't fit into this. Nuclear especially. So it's all coming. This guy with the name that's impossible to pronounce, copper is required at literally every single level of the AI build-up. We were talking about AI and natural gas above. Power plants and grid upgrades, hyperscale data centers, tens of thousands of tons each. AI servers and GPUs, EVs and robotaxis, 5G, 6G, and edge, robotics and automation. No copper equals no AI scale. Here's copper breaking to the upside. That looks very good. Now, I don't like a ton of the companies. I've got my favorites or favorite, and we're playing this. We're playing this baby. Let's let this thing rip. Transportation stocks says the transportation squeeze has arrived. We've got IYT all-time high breaking out, and we're seeing a squeeze on short interest. So transportation stocks break out when things are good, not when things are bad. So you can't remember the Michigan Consumer Sentiment Index that we showed earlier? Well, this chart doesn't agree with that sentiment index. I think things are about to get moving, and maybe perhaps lowering interest rates is going to spark that. Maybe, perhaps, and maybe we're going to get lower interest rates here very shortly, and I think that could spark the economy fired up, back up again. If they lower rates, I also think home sales and homes are all going to come back. And I think the doom and gloomers that are very negative on the housing market, I think they're all going to be wrong. That's what I think. And that's all I've got for today, guys. So that's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Special is the coupon code. And that's all I've got. So we'll catch you next time, guys. See ya.